Well, where did that come from? A monster upside surprise this morning. Good morning, good morning. Equity futures down because apparently good news is bad news for this equity market. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York, we begin with the big issue. The Fed has a lot more work to do.
The jobs report is quite key.
What Chair Powell told us is, well, he's data dependent.
It's really clear that they are on a path to continue to raise those rates.
With this jobs report and the inflation number due next week,
Certainly 75 basis points will be on the table.
That's why these data points coming up are so crucial.
A hugely important number in today's jobs report.
It's not only the strength of the labor market,
Labor force participation.
The key to bring out here,
the significant increase in wages.
A lot of answers we still need.
Payrolls today.
How the economy is going to react.
The Federal Reserve still has its work cut out for them.
Joining us now is Mike McKee. Mike McKee, what a number.
What a number. It took us all by surprise. Wall Street was leaning weak, but we got extraordinarily strong. More than twice as many jobs were created and restored than the consensus forecast had called for. 528,000 jobs in the month of July. June revised up to 398, a total for June and May of 28,000. The unemployment rate falls to 3.5%. That matches the low before the pandemic. Participation rate, though, falls to 62.1 as more people leave the labor force. Average hourly earnings stay the same at 5.2%. Does the Fed read that as inflationary or not? We'll see. The jobless story is interesting. This unemployment rate at 3.5%. The U6 rate only at 6.7%, unchanged from the month before. Discouraged workers apparently not finding more jobs. It's kind of hard to parse that out at the moment. But as I mentioned, labor force falls, employment rises by 179,000. And of that, in the establishment survey, 401,000 in the service industries. Unemployment down by 242,000 in that household survey. And John, we are now by 32,000 jobs above where we were when the pandemic started. We have regained all of the jobs that we lost and 32,000 additional jobs. We'll see if that keeps going when things get revised next month. But the green line there, I want to point out, if we had kept adding jobs at the pace we were before the pandemic, that's where we'd be. So you could argue that we're still short of where we want to be in terms of job creation.
Mike, did we just bury the recession talk, at least for the next month?
Yeah, there's no way you can get a recession when you have a 3.5% unemployment rate and you're adding jobs at the pace that we are. It does feed into this debate, the Summers and Fed debate over whether or not you can bring down unemployment or bring down the vacancy rate without raising unemployment. Vacancy rate dropped in June, and look what happened to the unemployment rate.
Mike McKee, looking forward to the coverage through today. Mike McKee there on the payrolls report, a blowout payrolls report. Off the back of it, futures lower down 1%. Because yields are higher by about 17 basis points on a 2-year to 3.2%. We're going to get a ton of research on the screen for you, a ton of reaction as well. This came from Neil Dutta of Renaissance Macro. A significant beat in payrolls with an even more surprising downtick in the unemployment rate. Recession talk is premature, along with talk of a policy pivot. This report is consistent with an inflationary boom, he says, 75 in September and on the table in November and December for this Fed. Joining us now, Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge. Mohammed, your reaction to that number from 33 minutes ago?
As Mike said, a very strong report. I like it, except for the declining labor force participation. What does it mean? Think of the economy, policy, and markets. Really good news for the economy. The most important part of the economy is going strong, and that will be celebrated at the White House, and rightly so. Go a few blocks to the Fed on the policy side, and they are not going to welcome this report. It's bad news for them in every single way. It makes the notion that we are at neutral comical. It means that they're going to have to go even more And the markets, you saw from what happened to the inversion of the 2s10s, it's now beyond 40 basis point, is saying that they're going to have to somehow break this economy to bring inflation under control. And for markets, as much as we've seen stocks come back, it is interesting that the 2-year now is all the way back at 320. So we've retraced, John, 35 basis points in the last week. And stocks are pretty robust. So the technicals are still favoring stocks right now, despite what you see on the screen.
Mohammed, it's a massive move. Larry Summers last week, after those comments from Fed Chair Jay Powell, said this to David Weston on Wall Street Week. Jay Powell said things that, to be blunt, were analytically indefensible. You also wrote an opinion column on it, and you talked about where we were in this range of neutral. You said, quote, "As to the general neighborhood for that level, I have a hunch, but I'm far from certain that we are still below it." Is your hunch? Mohammed, those comments from Chair Powell in that news conference, you've mentioned how ridiculous they look now. How on earth can we be at neutral, churning out this kind of jobs growth with CPI where it is?
We cannot. And that was an unscripted comment. It didn't go well with other things that were scripted, including his comment on the neutral unemployment rate, including all other comments. So this was unscripted, off the cuff, and we've had 4 or 5, I've lost count, federal officials this week walk it back. We're not at neutral. The Fed is going to have to do more, and hopefully it won't break the economy as it tries to catch up. It should have started, as you know, John, we've talked about this for over a year. It should have started much earlier, and now it's having to catch up frantically. And no one likes to see a central bank catching up frantically.
When you say more, can we put some numbers on more? 75 in September. What is more, Mohammed, for this Fed?
So if we get to September with things being where we are today, and that's a big if, yeah, 75 basis points and signal the possibility of another 75 basis points. That's what you would see. Now, things are fluid. A lot can happen between now and September. But this number is not going to be welcome. This report is not going to be welcomed at the Fed. This is bad news for the Fed's credibility.
Bad news for them, and they're going to go again, and maybe again and again. And Mohammed, I think we've got to think about how long we stay up there at that peak Fed funds rate as well. Because Alan Ruskin of Deutsche Bank put out some research in the last month or so, and he said in the last 3 Fed tightening cycles, the time spent at peak was 7 months in 2000, 12 months in 06-07, 6 months in 2018-19. Mohammed, are you giving a bit more thought to that? That once this Fed is done and gets to that peak rate, how long they're going to have to stay there?
So the 5.2% wage number is really important. Think of the dynamics of inflation. Phase 1 was energy and food. Phase 2 was broadening of energy and food into other components of core. But wages were well behaved, quote unquote. Weren't well behaved for the average worker because it meant negative real wage growth. Now we're seeing wages pick up, and with an unemployment rate down to 3.5%, a labor force participation coming down, jobs being created at over 400,000 on the 3-month moving average, you would expect wage rates to go even higher, not just 5.2% growth, but higher. So the next phase of inflation is going to be wage driven. If that occurs, it's good for the worker, it's good for the economy. However, it means that core inflation will prove to be much stickier coming down. So I do think that markets are a little bit premature in thinking that the Fed is going to start cutting rates aggressively early in 2023. It's going to take longer than that.
You're not alone. We've had a lot of banks come out with a lot of notes pushing back against a lot of this rally. Bank of America said take profit on the bear rally. HSBC said it's time to ditch stocks. Goldman said stocks could fall without a shift in the macro data. I wouldn't call this a shift. It's a shift in the right way. Barclays said the emerging Goldilocks narrative feels misplaced. This data would speak to that. Mohammed, I think it was HSBC again, Max Kettner, who said it was wishful thinking. We've had a massive rally, Mohammed, off the lows of November, or rather the lows of June. June 16th, we've had a move of about 20%. Mohammed, when you think about that, how much more weight we've added to the equity market rally in recent weeks, what would you be doing with stocks right now?
So first, what's happened isn't about fundamentals. I've stressed that. It's about technicals and it's about relative valuations. The technicals still favor the stock market. That's why the stock market has been so resilient to what has happened to rates over the last few days. Remember, there's a lot of money sloshing around the system. We've put a ton of liquidity in through all these central bank QE injections. Relative value. People are really stuck, John. They don't know where else to go. So stocks look like the best of, rather, a list of evils, if you like. So you got to respect the technicals, but on a fundamental basis, yeah, stocks shouldn't be where they are. But never underestimate the technicals. The technicals have to play out. We'll see whether the sorts of moves we're seeing today are going to shake some people out. But the technicals have proved to be very, very strong.
Mohammed, 210's at negative 42, pushing negative 43. What does that tell you? It
tells you that the market thinks the Fed is going to make yet another policy mistake, that they're going to end up by over-tightening because they've been so late. Remember the phrase, time, skill, and luck. That is what a central bank needs. It doesn't have time. It fell behind, and it lost that. So it needs a lot more skill and a lot more luck. And the marketplace is saying, you know what? I don't think you're going to have enough luck and skill to avoid an over-tightening that pushes ultimately the economy into recession. The economy is not in recession now. The economy is doing well now. But people are worried as the Fed catches up to reality.
Got a 20 basis point move on a 3-year right now, up 19 on twos to 3.24. Let's round that up for you. Mohammed, you're going to stay with us, I'm pleased to say. We're going to get Rick Reeder at BlackRock on the phone to weigh in on some of this as well. Equity market futures, we are down by more than 1% on the S&P. On the Nasdaq, we're down about 1.5% right now. Want to get you a flavour of some single names, some movers. Here's Abby.
John, well, we are certainly down, as you were just mentioning, by about 1% on the major averages. Not surprisingly, it has everything to do with that super hot jobs report and the idea that the Fed will have to continue to hike aggressively. That, of course, is weighing on big tech the most. Apple down 1.5%, Microsoft down about the same amount, on the idea that these stocks, the valuation is going to look more expensive as rates yields rise. Chevron, the energy complex, down too. This is oil is now sharply below support of its 200-day moving average. Oil below around $87 per barrel. And then the banks, which you would think would be helped out by rates rising, are down just a little bit. And that has everything to do with that yield curve that you and Mohammed were just talking about. At this point, inverted the most since August of 2000. And this market, this equity market, John, certainly feels like that long, slow bear market.
Abby, thank you. Coming up, DC gets some good news.
It's surprisingly strong, and it's a reminder of just, how strong the economy is. We're expecting an eventual slowdown, but it's not here yet.
We'll head down to Washington up next, and we'll continue the conversation with Mohammed and get Rick Reeder at BlackRock on the phone. That's next. This is Bloomberg.
It's surprisingly strong, and it's a reminder of just, how strong the economy is. We're expecting an eventual slowdown, but it's not here yet. The narrative going in here from the FOMC was the Powell pivot, and this is the payroll pushback. And the pushback is they're not going to be able to pivot as aggressively as the market was expecting.
Some good news for Washington, D.C. A blowout upside surprise payrolls report pushing back against mounting recession talk as the Biden administration inches closer to passing a key piece of its domestic agenda. For more down in D.C., let's get to Anne-Marie. AMH, that is a monster number.
It is a monster number, and as Mohammed El-Arian just told you, Jonathan, it's going to be welcome news at the White House, maybe not so down the block at the Treasury or the Fed. But for a president that has been very suffering in the polls, the economy is the #1 concern for the electorate because of inflation. This just goes to show the economy is strong and healthy. How do you call this a recession when the unemployment rate is at 3.5%? Not only has the administration will claim, not only has they recouped all the jobs lost during COVID-19 pandemic, but they also added 32,000 more on top of that. That is going to be the message for the next 24 hours.
Anne-Marie, thank you. And in the next 10 minutes as well, in about 15 minutes, we'll catch up with Secretary Walsh from outside the White House. Joining us now on the phone is Rick Reeder of BlackRock. Rick, what a monster number. Your thoughts on this one?
Pretty incredible, Jonathan. I mean, you can't, no matter how you parse it, it is consistently strong. I mean, across the board. I mean, stunningly strong. You know, what's amazing about this number is it's incongruent with the claims data that showed some softening, the JOLTS data which shows openings slowing, the surveys you're seeing in the ISMs and otherwise. And by the way, companies, one after another, the Walmarts, the Amazons, the big employers, talking about layoffs and certainly slowing down hiring. So it's an impressive number, and it's surprisingly so.
Rick, are you changing your thoughts about how much work the Fed needs to do? We talked a number of months ago, and you said maybe some weakness starts to come in the labour market. We don't see it yet. What are your thoughts on that now?
John, that's exactly right. I mean, you have to assume that the Fed's going to do 75 in September now. I think that's got to be your base case. And then, while the economy's moderating in a number of places, you're seeing it, certainly in housing, certain parts of the industrial complex, you're seeing it, retailing, you're certainly seeing it. But, you're not. I mean, the people, it's certainly not, when you've got a 3.5% unemployment, pretty strong. And so I think you have to assume that the Fed's got more work to do before slowing it down. I mean, the markets have been pricing in a flip to the Fed easing aggressively, which quite frankly was hard to believe, was presumptuous to say the least. But now you have to assume that they're going to go 75, draining liquidity as well. And so you have to build that into your asset allocation matrix for sure.
Let's build that in right now. You've talked recently about putting a little bit more cash to work. You've had that dry powder through much of this year. Rick, how have you been using the recent strength both in equities and in credit too?
Yeah, so, it's funny. We've been letting the line out a bit, as you said, Jonathan, across risk assets. But the place we feel by far the most comfortable is in the credit markets. You take, the fear of recession or growth slowdown, your interest coverage is still great at companies, and you've priced the bond market, the credit market has priced, quote unquote, recession much more aggressively than the equity market has. And you're getting paid for it, whereas defaults are actually going to be quite moderate. So we've definitely been adding in credit. We talked about last month on your show, still like it. And actually, quite frankly, hopefully you see some pressure here on spreads, because I do think the credit markets are attractive. You're getting yield now in the portfolios that are pretty generous that we haven't seen in a really long time. And you have to assume the Fed's going to continue to tighten financial conditions, but credit markets are a place you're getting paid for it. Other markets, I think you got to be a bit careful about risk, given the Fed's disposition from here.
When you say other markets, do you mean stocks?
It is. And I heard Mohammed describe it. I think he's exactly right. The technicals have been impressive. You get some stock buybacks, and you get the technicals, meaning people aren't long, haven't been long, and the equity market just sort of floats higher into that. And I think it's, I think the stock market's okay. I mean, I don't think it's terribly rich, but given you've got an uncertain set of economic conditions, this number notwithstanding, you've got a Fed that wants to tighten financial conditions. It's just okay. And I'd rather take my risk, get carry into our portfolios, get interest income in the portfolios more aggressively than taking a lot of beta risk.
Hey, Rick, awesome to catch up. Thanks for jumping on the phone. What a report. Rick Reeder there of BlackRock. Mohammed waiting patiently for us. Mohammed, thank you for that. Rick talked about it, the tightening in credit spreads. We've had 140 basis points of tightening in a single month. We've had a 20% move on equities, Mohammed, on the NASDAQ going back to the middle of June. That's an easing of financial conditions, Mohammed. And when we talk about the Fed needing to do more work with Fed funds, what do they need to do with financial conditions?
They need to tighten financial conditions. And as you point out, it's been going the other way. And part of that has been due to their commentary. We've had failures in not just analysis and forecasting, but also in communication. John, the other thing I would keep an eye on, and we haven't talked about, is what does it mean for the rest of the world? The dollar is strengthening again. That's not good news for the rest of the world. And for those who are very tempted to fade the U.S. and favor other parts of the world, this is going to be a warning to them. I think the U.S. remains, in relative terms, the strongest economy and the most attractive markets right now.
Mohammed, yesterday you congratulated the Bank of England for being what you said was honest, transparent, open. They're forecasting a recession that starts at the end of this year, inflation that runs maybe peaks at 13%, perhaps more, and the story's sticky into 2023 too. What would you like to hear from this Fed? And Mohammed, do you think they have the luxury of being as open, as transparent as Governor Bailey has been?
So they need to do something. John, you quoted Larry Summers. You could have also quoted former Fed officials that have called Fed projections laughable, dreamy, fairy tale. Look, the Fed has to restore its credibility. It has to be seen as the trusted advisor that puts out their honest, non-political projections. That is absolutely critical. You need that in a system. That's why you give central banks political independence, for them to be technocrats, not to be politicians, to be technocrats. Go to the Bank of England, and Governor Bailey's being unfairly criticized today for being dead honest. You know, it's not easy for a central bank governor to say inflation is going to go up to over 13%. We may fall into recession in the fourth quarter, and it will last most of next year, and the balance of risk is on the downside. That is a really difficult message to give. No one wants to give that message. And yet, Governor Bailey had the courage to do it. The Bank of England had the courage to do it. And I think it's important because what does it do? It acts as a catalyst for let's get policy reaction so that we don't end there. Okay? He's saying, given the current policy configuration, that's where we're going. Because you hope you're going to trigger a policy reaction because people say, I don't want to go there, and you'll get the proper policy responses. And that's why it's really important to have a technocratic central bank.
Mohammed, I want to take this a little bit longer, so I'm going to ask the control room to blow this break and take this at least for another 3 or 4 minutes. It's a long, long road to September and the next Fed meeting. The next Fed meeting is September 21. Next week, we get a CPI print. In early September, we've got another jobs report. Then I think we've got another CPI print on September 13th, August 10th next week, September 13th, the next one. That's a long road, Mohammed. Are you expecting any of this to change before then?
So I'm hoping that headline CPI is going to come down. I'm hoping that core CPI doesn't go up. That's the one I'm really worried about. I'm worried about core. I'm less worried about headline. I think we're going to see the 9.1 come down. I hope the economy remains solid. You know, I hope somehow we can get control of inflation without undue damage to the economy. That's not, unfortunately, my baseline, but there is a possibility. But as you say, we're going to find out a lot. And Jackson Hole is going to be important because that's going to update us from a strategic perspective as to what the Fed and what Chair Powell in particular is thinking at this stage.
Mohammed, the balance sheet hasn't had enough discussion for me. QT's kind of taken a back seat in a way that it didn't back in 2018. Why do you think that is?
I don't know, John. I mean, the Bank of England was very explicit in terms of active sales. We haven't heard this. Look, it's critical for the Fed to update its framework. Remember, we are still stuck with a framework that's calibrated for an economy with insufficient aggregate demand. We don't have insufficient aggregate demand. We have insufficient aggregate supply. So the Fed should be looking at its framework and rethinking its framework, even though it's just over a year old. And in that context, it has to think not just about rates, but also about QT.
You mentioned the rest of the world, Mohammed, and maybe let's finish there. Where do you think this leaves the global economy and the risk elsewhere, particularly in emerging markets, with the Fed that's going to have to be much more aggressive in your mind than many people are anticipating and potentially stay there for quite a while?
Yeah, it's going to test the resilience of the rest of the world. You know, stronger dollar, higher rates is not something that developing countries welcome. It complicates their lives because it means higher imported inflation. It means that capital markets become less predictable. So we are going to test the resilience of the rest of the world. Now, the good news is relative to where we've been in the past, the average resilience is higher. The less good news is that the dispersion is quite wide. So I worry in particular about the most vulnerable developing countries.
Mohammed, awesome to catch up. I know you've got to jump on another call, and we appreciate your time this morning. What a move we've seen, and what a jobs report as well. Mohammed, a great friend of this programme, of course. With futures lower, yields higher by, let's call it 20 basis points on a 2-year. We can round this up to 324. It's just a massive move. What Mohammed said about 20 minutes ago. The Fed is going to have to break the economy to bring down inflation. The Fed is going to have to break the economy to bring down inflation. That's Mohammed's view. In a moment, we'll get the view of Anastasia Amoroso of iCapital. We'll get the view of Mike Collins of PGIM. And we'll get the view of this White House. Secretary Walsh just around the corner for his view on this report and a little bit more good news. In fact, I'd say a little bit more and some in this jobs report for this White House. Futures down on the S&P by a little more than 1%. Yields higher by 20 basis points on a 2-year. And this curve inversion, 2s 40s, 2s 10s, now negative 40 basis points. Big, big news this morning. This is Bloomberg. Here's a number for you, 528,000. We were looking for 250K. That's what we call a monster upside surprise. That means futures are down. They're lower by 1% on the S&P 500, on the Nasdaq down by 1.6%, and I hate it. I hate it when good news is so-called bad news. And here's the why. Switch up the board and get to the bond market. There's your opening bout for equities. Yields higher, aggressively so, by 13 basis points to 282 on a 10-year, much more so on a 2-year, up by around about 20 basis points on a 2-year yield this morning. Just unbelievable. In the FX market, yields up, dollar stronger, euro down. Euro dollar down to 101.55, negative 0.9%. And crude, get used to not sub 100, sub 90 apparently. $87 and about 15 cents. We're down by 1.6%. That's the cross-asset price action. About 30 seconds into this one. Let's get you some movers. Here's Abby.
John, well, sticking with that good news is bad news macro theme, it's all about big tech weighing on the markets today because, of course, as yields surge higher on that monster jobs report, that pressures big tech valuation. Apple down 1.3%, Microsoft down 1.1%, NVIDIA, the chip maker, the chip giant, down 1.8%. So we have some real weakness for this tech sector. We also, interestingly, have weakness for the banks, the financials, not in a huge way. Bank of America down 0.3%. This, of course, as yields surge, but the yield curve, as you've been mentioning, inverted by more than 40 basis points at 210, the most since August of 2000, John, and it's hard to not remember that bear market then where there were lots of rallies and then drop, rally, drop over a long period of time. It almost feels that way again. But today, of course, we do have some weakness on that monster jobs report.
Abby, thank you. Ian Shepherdson of Pantheon Macroeconomics out on Twitter right now. How's that recession call going? I'd say not well this morning. Equities are down about 1% on the S&P. On the Nasdaq, we're down by 1.2. Big tech under pressure. Taking a look at that. Here's Taylor Riggs.
And John, the numbers, of course, through yesterday's close, when you think about sort of the big rally that has been underway from the low that we had June 16 up until now, up more than 19%. We'll, of course, subtract a point from that this morning when you think about sort of the big rebound that we had. Okay, 17.8%. So not sort of quite out of that bear rally, but sort of clawing our way out of that. When you take a look at maybe some of the individual sectors, or if we go sort of out of sort of the NASDAQ, you can see ARC, of course, had been up through yesterday, 37%. Stocks index, of course, biotech had already sort of climbed its way out from the big lows, up more than 20%. As you know, though, it always comes down to not only the big jobs report today, the CPI next Wednesday, and the pivot from the Federal Reserve, or maybe no more pivot. If we're thinking, are we still dovish, or are we now going to be hiking 75, maybe 100? It all comes down to the earnings outlook, and that's what we're looking at as well here. When you think about big tech, the rate story is, you know, sort of the input into that discount cash flow model is all about rates, and of course looking out for a bottoming out of some of the earnings revisions, lowers as well, to signal out a bottoming of this market.
Taylor Riggs, thank you. The Fed has more work to do, and that means maybe we've got some more wood to chop on the Nasdaq. We're down about 1.4% on the Nasdaq right now. Bank of America publishing moments ago, we now look for the Fed to lift the target range of the Fed funds rate to 350 to 375 by year end, and you'll hear the 4 a lot more going into CPI next week, and we'll see whatever CPI is. Right now, then, down 0.9 on the S&P, on the Nasdaq down by about 1.26%. We reverse the recovery rally with yields absolutely surging. Good news turning into bad news for markets. A monster upside payroll surprise, fueling bets for another big rate hike. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Well, that's reflected in the cross-asset price action. Not just stocks down, but the dollar stronger on the day. And as you said, Treasury yields are absolutely flying, more so on the short end, which, of course, is the pricing of more aggressive Federal Reserve rate hiking. The 2-year yield right now on the day up 18 basis points to just shy of 323. And of course, that puts it even more ahead of the 10-year yield. Right now, that curve inverted by more than 40 basis points. That is the deepest inversion going back 22 years to August of 2020. And usually that is an indicator of a recession, though, as you've alluded to, this doesn't look all too recessionary at the moment, as the market is pricing in a greater odds of a 75 basis point hike next month, John.
Kaylee Lyons, thank you. Thank you very much. Just breaking down some of the data and what this all means for the Fed. I'll break you down on what's going on in this market right now. About 4 minutes into this session, equities are lower by about 0.8% on the S&P 500. On the Nasdaq right now, we are down by about 1.15%. I'll give you the sector breakdown as well on the S&P 500. You can work out where things might be going, given what's happening with yields now, up by about 20 basis points on a 2-year. Information technology down by 1.2%. I want to run you through the bond market as well. 2s, 10s and 30s shaping up as follows. On a 2-year yield, up by 19 basis points on a 2-year to about 323. On a 10-year at the moment, yields higher by 13 basis points. So the heavy lifting happening at the front end of the curve. That means the curve inversion, 2s versus 10s. Now negative 40 basis points. And Tom Keene and myself a little bit early this morning said the same thing. A shout out to Priya Misra of TD, who was looking for this. Just a monster call from her. She said negative 40 basis points on 2s, 10s. Right now this morning on 2s, 10s, we have negative 40 basis points. On Bloomberg TV and radio, I'm pleased to say that joining us now is Labour Secretary Marty Walsh off the back of this stellar jobs report. Secretary Walsh, the floor is yours, sir. Your thoughts on this one?
No, thank you very much. This certainly is a great jobs report. When you look at the different sectors, most of the economy is recovered. The jobs that were that companies had pre-pandemic are all returned, so it shows good gains. We've showed some good wage growth. We've shown good areas. Manufacturing is one of those areas that certainly we've seen come back, not just come back to pre-pandemic levels, but go beyond that. I think with the CHIPS bill that was passed and it's going to be signed into law next week, we can do more manufacturing in the United States of America, which in the long term will help us with some of the inflationary pressures such as semiconductors and more microchips.
Secretary Walsh, what a turnaround this has been since the pandemic. Can we just take a moment to think about that, how much we've recovered over the last couple of years? And can you talk to me about how sustainable you think these jobs gains might be?
Well, I'll tell you, pandemic, March of 2020, I was the mayor of Boston, and we were shutting businesses down. We were shutting restaurants down. We didn't really know what the economy held. And thinking about where we are today was really incredible. And I think that this will, in my opinion, will be sustainable moving forward. I think companies are understanding. I think we're going to have a new type of economy. I think we're still obviously dealing with inflationary pressures. You talked about it right before we got on the air here. I heard you talking. And I think that, you know, we're going to adapt and adjust and we're going to move forward. I think that the infrastructure law that was signed into law, we're going to see more investments all across America on roads and bridges. I think with the CHIPS bill that was passed and move forward, we're going to see more investment in manufacturing. Hopefully, the bill that's being worked on now in front of the Senate is going to be working on prescription drug costs and environmental climate change and some other areas is going to help. When you really think about a lot of what's happened here under the Biden administration is something that we've talked about for the last decade or so, and these are all going to be good bills and good investments to move our economy and, quite honestly, move America forward.
I know you've got a lot of people to talk to this morning. I did want to talk to you about the negotiations on the West Coast with the ports. This was your quote. I know you were, because this was your quote last time we spoke. You said, next month if I come on this show, if we don't have a contract and we're not close to a contract, then you and I might be having a very different conversation. So I guess, do we have one? Are we close to one? Or are we having a very different conversation?
No, we're not. I don't know how close we are to getting a contract, but one thing that has happened since we've spoken and both sides have agreed is the health care. And that was a big sticking point. That's usually a big sticking point, the costs around health care and who's going to pay for health care. And that was negotiated and solved about 10 days ago. So I'm very pleased with that. Now they're on to the next phase of negotiation. And usually when you think about contracts negotiation, the biggest sticking point is around health care, pensions, things like that. And those are in the rearview mirror now. Now they're moving forward on some of the other issues they want to tackle. So I feel good where we are. If I said that, I probably should have used my words a little better if we don't have a contract by next month. But I am very confident where we are in the negotiation right now. I am not concerned. And I stay in very close contact with both the longshoremen union and the companies on the ports to offer any type of support we need. But every time I talk to them, they say we're moving forward.
Secretary Walsh, for some people who might not be that confident as you are, they might not be familiar with how this works, with this particular set of negotiations. As you said before, this particular one's a little bit different because it only starts 6 weeks before expiration. Can you help us understand things a little bit better by comparing it to 2014, where we were then at this stage and where we are now?
Well, I think we're further along than we were in 2014. If I remember, that took an awful long time to get done. But just for people that don't quite understand collective bargaining or negotiations, usually you can start months ahead of time to lay down the foundation for a contract. In this particular case, it's 6 weeks before the termination of the contract, which means it always runs over the expiration date. I don't think they've ever had a contract done on the expiration date itself. Normally, you want to shoot to get a contract by expiration date. But what both sides have agreed to do in this case have continued to agree to keep the current collective bargaining agreement in place while they negotiate moving forward. There's been no conversation of strikes, lockouts, slowdowns, none of that stuff. That hasn't even broached or brought up and talked about. And that's the thing that I don't think will happen in this negotiation. And I'm going to continue to talk to the sides, and where I need to put pressure on them. Certainly this is a big issue for the ports and for products coming into the United States of America, and quite honestly for exports out of the United States of America too. So we want to stay very close to that. Myself and General Lyons, who's the liaison at the White House, has been in constant communication. We talk a couple times a week, but we have a scheduled call just to go over where we are, just so we can stay on top of these negotiations.
Secretary Walsh, a monster jobs report. It's the final question from me for Boston. Do we need to see some Labour turnover at the Red Sox?
Oh, God, I get myself in trouble there. I'm not really sure what's going on there, although they seem like they didn't make many changes. So they're going for something, so they must be going for that wild card spot.
That was from Mike McKee and Tom Keene. They were pushing me to ask Secretary Walsh. They had to go there. It's good to catch up with you, sir. Thank you. Labour Secretary Marty Walsh there on just a killer jobs report. I'll keep going through the price action. Mike McKee's going to drop by again and go through the labour market report after his 5th, 6th, 7th, 8th look at it. We'll get the view of Anastasia Amoroso and Mike Collins of PGIM and iCapital, respectively. We're coming off the lows here. On the Nasdaq, we're down about 0.8%. On the S&P, we're down 5 or 0.6%. In the bond market, just some big moves off the back of a big number. Up 18 basis points on a 2-year to 3.22. Coming up, investors looking ahead now to CPI data next week.
We're looking for another strong gain. So, the headline's going to be weaker just because you had that huge pullback in gasoline prices. But that shift from 1.3% to 0.2%, which is what we're looking for, it almost entirely stems from energy.
That conversation up next.
Few blocks to the Fed on the policy side, and they are not going to welcome this report. It's bad news for them in every single way. It makes the notion that we are at neutral comical. It means that they're going to have to go even more, and the markets, you saw from what happened to the inversion of the 210s, it's now beyond 40 basis points, is saying that they're going to have to somehow break this economy to bring inflation under control.
That was Mohamed Al-Arian earlier this hour. The US payrolls report coming in hot with a host of data still coming next week. The main event, CPI on Wednesday. Mike McKee back with us for more. Hey, Mike.
Hey, John. We have a very strong report that takes care of the mandate for the Fed to bring down unemployment. We come in with 528,000 jobs for the month and an unemployment rate of 3.5%. That matches the low in January 2020. Pre-pandemic, average hourly earnings unchanged at 5.7%, and of course now we're 32,000 jobs above where we were when the pandemic started. So all good news for the president and for workers. Whether Mohammed's right about the Fed, we'll find out next week when we get the inflation numbers. Next week is all about inflation in the economic data. CPI on Wednesday, PPI on Thursday, Friday import prices, and it's going to be interesting now to see what happens with this Michigan number, whether sentiment overall improves because of this, and whether people think it means, along with the gas prices coming down, that inflation is going to come down, and the Fed has a little bit less to worry about in terms of inflation expectations.
Still reacting to this one, Mike, this 528. Just a final word, Mike. I asked this question earlier. Does that pass the smell test from your standpoint?
I don't have any reason to think it doesn't. There isn't a seasonal factor in the July numbers that should really worry us, but it is odd. It's hard to explain other than companies just hired. You'd think more people went into the labor force, and so they were able to fill some of those job openings, but the labor force shrank. So I don't, at the moment, have a good explanation, but fortunately there are people smarter than me who will figure it out.
I'm sure they'll figure it out in the next few hours. Mike McKee, thank you. It's a fantastic number, that's for sure. The president taking a victory lap of sorts, saying it's the result of my economic plan to build the economy from the bottom up and the middle out. It's a favourite line of his. I ran for president to rebuild the middle class. There's more work to do, but today's jobs report shows we are making significant progress for working families. 528,000. PGIM's Mike Collins, iCapital's Anastasia Amoroso. They join us. Anastasia, you've had a bit more time to digest some of this. Your thoughts on this one?
Well, John, good morning. And I know you don't like the interpretation that good news is bad news, and I don't either. And I actually think that good news is good news here. And the labor market is still exceptionally strong. And that means that we can put some of the recessionary fears to rest. And that means the economy is still doing just fine. And the reason why that's good news is because I think there is a path to be had to soft landing here that the Fed so badly wants to engineer. So they're going to run the GDP growth below potential, but they're also going to bring down the job vacancies, but not necessarily the job creation itself. And that should not produce a big rise in the unemployment rate. That should be good news for the markets. I know that's not what we see on the screen right now, but the reason that should be good news for the markets is because if everyone is so worried about having to haircut the 2022 and 2023 earnings estimates, maybe we don't have to do that if we're not actually going to a recession. So my interpretation here is this is boomy, this is solid labor market, and the markets should over time welcome that. And by the way, it is too premature to think about what the Fed is going to do. We're still 2 CPI prints away from the next Fed meeting.
No, well said. It's a long road to September. Mike Collins, your thoughts, sir?
Yeah, Jonathan, I'm really in Anastasia's camp as well. I think people who think good news is bad news are kind of missing the big picture, right? If you just think about the different scenarios out there we've all been talking about, and I would ascribe almost before today, maybe a one-third probability to each of these scenarios. The first one is really Anastasia's, that you have just a soft landing, a moderation, GDP, 1 to 2%, inflation coming down. The other one is kind of a mild recession, which is the camp I've been in, where GDP averages maybe 0 for a year and a half. And then the third one is really the one everybody's worried about, the deep recession, which is mostly driven by stagflation, right? Higher prices and lower growth, really forcing the Fed to push it and break the economy, as Mohammed said. But I think the probability of that stagflation scenario has dropped significantly, meaning risk assets don't have to reprice dramatically if you're in one of those other two scenarios.
Mike, 2's 10s, -40. How much oxygen is left in that trade?
Yeah, that seems really, really deeply inverted, and I would take the other side of that, Jonathan. I think there's a good chance that the Fed doesn't go to 4 or 3 5/8 and then have to cut 100 basis points in the next 12 months, which is what's being priced in right now. I think there's actually a reasonable chance that they get that funds rate into the 3s, and maybe they're able to keep it there for a year or two. So, as Tom Keene would say, maybe that x-axis is getting pushed out a little bit. Maybe the funds rate stays kind of in that range. So I think you're supposed to fade this inversion a little bit here.
Anastasia, a lot of people have come out this week and said fade this equity market rally. You just said good news can be good news. Where in this equity market should it be good news?
Well, I think good news is that maybe we don't have to retest and break below 3,700 that we've seen before. And the reason I say that, if people start to have some confidence that $240 on the S&P 500 next 12-month earnings estimates can hold, then maybe you apply a slightly lower multiple to that. But at least you don't have to haircut that into the 220s that everybody feared. And so the good news is that, maybe, we give a little bit back here. We fade some of this monster rally that we have had, but we may not necessarily have to worry about another, 20% down from these current levels. So, don't get me wrong. I do think this market continues to be range bound because we've got fears about hot inflation on the one hand, and we've got fears of imminent recession on the other hand. So this market is sort of trapped here, but I think we kind of know what the trap now looks like. It's between 3,700 and probably 4,200 on the S&P 500. So it would be nice to break above this range, but we're probably not going to do that in the meantime. So I would focus on getting paid while you wait out this volatility. I would focus on buying equities if we do get down to that $3,700 level, but that's really the playbook for now.
Bank of America is exactly with you, almost exactly the same numbers, almost precisely. They're looking for a range of 38 to 4,200 until the next Fed decision in late September. And as Anastasia said, the road to September is long, long, long. Mike Collins, we've had a ton of credit spread tightening, 140 basis points in about a month. Mike, does this jobs data validate some of that move or disrupt it because the Fed's got more work to do?
Yeah, I think last time I was on, when high yield spreads were approaching 600, I said we're kind of fully pricing in now that mild recession scenario, but not necessarily the deep recession. And now I think we're pricing in, kind of this maybe a higher probability, as Anastasia said, of this soft landing scenario where maybe, we stay a positive GDP growth on average for the next year. And I think that's kind of what's priced in here. But similar to Anastasia's, range-based trade here, I think we're in the same in the credit markets. I think you're going to be in this pretty wide range in high yield spreads, between 400 and 600, and you're earning a lot of carry, right? If default rates stay low and you're good at picking the credits, I think that's a lot of spread and a lot of yield in the credit markets, in the bond markets, and I think you're going to earn a lot of that yield for the next couple of years. So you have to be in the trade.
Mike Collins, what a moment. Anastasia Amoroso, happy to share it both with you. Just a massive upside surprise to the both of you. Thank you. And a big move at the front end of the yield curve, up 18 basis points. The takeaway, universally, is that the Fed has got more work to do. That's the conclusion. Citi coming out just moments ago saying we continue to expect a 75 basis point rate hike in September and a march to 4% policy rate by the end of the year over at the Fed. That's the call from Andrew Hollenhorst over at Citigroup this morning. Coming up, the market moving events you need to be watching. That'll be next in our trading diary from New York. This is Bloomberg. 25 minutes into the session off the back of this one. Still trying to process that number. Just absolutely massive. Down about 5 or 6/10% on the S&P 500. The Nasdaq doing okay relative to the rally we've seen. We're down about 1.2% on the Nasdaq 100 in response to what's happening in the bond market. 2-year yields absolutely flying, up 19 basis points on a 2-year, on a 10-year, up about 15. So 2s versus 10s. Something like -40 through much of this morning. That's the price action. Here's the trading diary. You'll hear from the president, a happy president, I imagine, at 1 p.m. Eastern. Then we get the latest read on inflation with US CPI next week on Wednesday. Ton of Fed speak from the likes of Evans and Kashkari. US PPI and another round of jobless claims on Thursday. Then we round out the week again with the University of Michigan Consumer Sentiment Survey. From New York, that does it for me. Have a wonderful weekend if I don't see you on Bloomberg Real Yield a little bit later. This was the countdown to the open.